So today is the 15th of September, and we're here today with Philip Byrne, Deputy CIO and Head of Trading with Merrion Investment Managers, part of the Cantor Fitzgerald Group. Phil, I think we're meeting at an interesting time. It feels like we have had a lot of bad news. I'm just going to run through what we've been putting ourselves through recently. So obviously we're very familiar of the recession fears, the economic growth outlook. We've also had non-stop news about inflation and how it has failed to be as transitory as we were first hoping. Energy prices, anybody who's driven recently and is looking into heating their homes towards the winter is already getting worried about that. And then of course we've had the central bank news. So really my question is, should we be running for the hills?
Yeah, well, first of all, thanks everyone for coming. As you said, yeah, an incredible year, both for markets and the economy. And it's one of those years where all the topical issues that everyone's facing in their day-to-day lives are actually also what's driving the markets as well. And so it's made for quite interesting discussions in things like this. We don't for one second underestimate the problems that have been facing people, the economies, and the markets year to date. Where we differ from people is we feel that people underestimate how strong the economies, the consumer, the corporates were going into this year and their ability to withstand any crisis. This particular crisis this year is an inflation one, energy inflation in Europe and broad-based inflation in the US. And we feel probably more than most that a lot of these problems are behind us and the solutions are closer than is realized.
I think something that I saw this morning was history suggests that once inflation has peaked, equities can be expected to rally. How true do you feel that might be?
Yeah, again, we feel that for all the bad news flow that we've had in the summer year to date, is where markets actually bottomed about 3 months ago already. They bottomed early June. So in spite of all the energy price increases we've seen in August, the interest rate headlines around the Fed, the ECB, markets at the moment, they could always go lower, but have actually bottomed in June. And what's been interesting for us when we were going through what's led the markets higher since then, so we look at the relative performance of stocks and sectors kind of under the surface, it would be stocks and sectors that are indicative of a strong economy with strong growth and strong inflation and continued elevated interest rates. So it's more encouraging than the people would have you believe in terms of what the market is thinking for a recession.
And in terms of, a lot of the talk is this, we're almost talking ourselves into a recession. Do you think that's fair, or are central banks going to be able to do their job?
Yeah, I think it's because it's different on which side of the Atlantic you're on. I think in Europe, the main problem, everyone knows, is energy prices. And in particular, what's happened in the war in Russia. There's an old saying, when the policymakers panic, as an investor, you can stop. And 2 weeks ago, the policymakers panicked. And the intervention that they've put into the European power price market will fundamentally change how we price power in Europe going forward. It also means we'd be fairly confident that we're at the peak power price and gas price in Europe. So it's more elevated, obviously, than this time last year. It's more elevated even than in March, but just that peak pressure that we've been under is now abated. And I can go into that if you want.
Yeah, I think...
So essentially, so everyone knows the power price in Europe is set by the gas price. Even though it's only about 30% of how we generate power, it is the marginal energy supply. So that was decided a long time ago. That's how you set the power price, which is electricity. Russia invaded Ukraine. There was concerns obviously about the gas price. It shot up in March. It came all the way back down in June. And then in June, when they turned off the gas supply from Russia, the gas price elevated again. But what actually happened really was in August, the power market essentially broke, for want of a better word. And we live in a hyper sort of financialized economy. And why it broke is because utility companies, so the power price went up because the gas price went up, but it went up far beyond what it should have. And the reason is because people or utility companies sell their power forward. They effectively hedge it. And when you hedge something, you have to put margin. So the more the price was going up beyond any, like it went up tenfold in Germany over August. Like it was the equivalent of when the oil price went negative at the bottom of COVID. And when it went up so high that the margin calls, Statoil, or Equinor as they're called now, said it was a $1.5 trillion margin call effectively for these power companies who had to keep trying to either post margin or hedge the power. So the thing just exploded and it broke, and you've seen all these people, Panda Power and Uniper, go and have to be nationalised in Europe. So that is what caused the Europeans to intervene. And what they've done is, the first thing they've done is they're saying the gas price will no longer set the power price, in that we have to include the price of renewables, which is effectively free once you've invested, nuclear, coal, like it's a much more sensible, broad-based basket. So that's the first thing they did to try and break the link between gas and power. The second thing they did is they effectively gave unlimited liquidity to all these power companies, so you didn't get this big margin squeeze. So all this forced buying, that was nothing to do with the demand for power. It was literally it was a financial problem, like kind of Lehman Brothers type thing. It was a financial issue. That's all ended. So already we've seen, like German power prices, for example, they've halved in the last 6 weeks. Which is taking the pressure off massively. What they're also then doing is, is that the gas price now is based on the pipe price from Russia, because that's where we used to get all our gas. Well, that makes no sense now because we don't get it through, we all get it through LNG. So they're trying to link the benchmark gas price now to LNG, which at the moment is 30% cheaper than the piped gas price. So when you put them all together as measures, you can see already that what we experienced over late in the summer will end, and hopefully, although it takes a while to filter through to the, you'll probably see headlines of retail power price increases in the next month or two. That should be the peak, of the actual rate, and it'll come back down. Goldman's in particular have been very good on the gas price. They see European gas prices halving by the time we get through to the end of the winter. And the other point to bear in mind, and this is why people are so concerned about the recession, the other fear out there is that there's going to be a shortage of gas in Europe for the winter. We think we'd be as confident as we can be that there won't be, and the reason is because Europe has paid up in the LNG market to bring the gas in. So it's not going to be a double hit. For gas in particular, it was either pay too much for it or not have enough of it. And Europe has gone into the LNG market, for anyone who doesn't know, is now a global market where you liquefy gas, you put it on a big boat, and it moves around the world. It's an early industry, but it's what's growing the most. So Europe at the start of the summer used to be about 10 or 15% of global LNG imports. It's now 30%. And the reason it can go in and do that is because the places like China, they can use coal. They've taken some gas from Russia. Japan has said, well, we're not paying that for gas. We're going to turn on, I think, 27 nuclear power reactors. The whole world has reacted to it and tried to solve the problem. So although at the moment, and this is, it sort of paints to a bigger picture about markets and investing, and that, like, when there's a problem, the problem is always presented in the media and in the financial media, but there are hundreds and thousands of people trying to solve it as well. And the analogies between the gas price now and COVID is incredible. If you all remember back in March and April 2020, the general consensus was 3 years for a vaccine. Well, actually the first thing was we need to get PPE from China, and we can't get PPE. Then it was, it'll take 3 years for a vaccine. Then it was like, well, we'll get the vaccine, but it has to be stored at 20 degrees. There's all, and there are problems, but when you look at the world bottom up like we do, there's just thousands of companies, corporates, dare I say politicians, like trying to solve it. And that's where we feel we are on the issue within Europe, and gas. So we feel there will be enough gas. The other thing that's happened, obviously, this is assuming the rationing demand will come in, but it's not that bad. 5% at peak we have to reduce our energy supply by, and the other thing we've seen is a incredible amount of switching by industry in Europe already, in terms of switching out of gas into oil, diesel, renewables. Like every company just has their own way of doing it, moving production to Germany and something. So far, like as we sit here in the middle of September after 9 months of this sort of supposed, it is the biggest cost of living crisis or energy crisis in Europe, there's still no effect of it yet, right? So there's still no, actually it was on a call yesterday, European GDP is actually going to go up for this quarter estimates because the Spanish and Italian tourist season was so large, that it overweighted for now. So that's all pretty good. And then even probably more important for everyone in the room is the fiscal response from governments. Again, the economies, the Western economies have gone into this slowdown crisis so strong, and you can even see the measures we're going to have here next week. It's talking about a €6 billion budget, €1,000 tax cut per person, €600 of further electricity credits, another €200 a week childcare. Like it's thousands and thousands governments are giving to to the voters, and this has been replicated in Germany. The UK one, which you can get to, is colossal. So since COVID, there's just been this expectation from the governments that Western living standards can't drop, and that they will go in and at a fiscal level try and offset it. So that's why when we weigh all these things together, like, is our gas price, are we all going to be paying higher for gas and electricity this year? Absolutely. Is the peak? I think so. Our government's going to offset a lot of it? Yes. And the markets, which, the main point we're here, have actually discounted or had fallen for none of the solutions. So you can sit, and if you like, European industrial stocks down 20, 30, 40%, the DAX is still down 20. But so that's the dilemma the market prices in initially a problem, and then all the solutions come to the fore, and we just start getting through it.
And I think that's a really good point that you make in terms of the market and how MIM view the world, because we're lucky enough to have Phil or one of his colleagues on our morning call on a Monday to give us their view of the world. And this Monday, as it has been for the last few Mondays, I think you've been telling us you're positive, you're up at the upper end of your allocation to equities. So you're obviously feeling buoyed by markets. Yeah,
like we're fully invested. Like I said, it's not to downplay how bad the issues aren't. It's more how, I said, strong companies, corporates were going into the crisis, how it's been managed, and the valuations now you can get on assets. Because what we're always talking about now, and these events always end up talking about the cyclical issue of the day. So everyone cares about the gas price now. If it was February, it would have been the oil price. The oil price is $140. It's now 85. If it was last year, it would have been Omicron. If it was the year before, it would have been the Delta variant. It would have been the vaccine. Then it was Trump. Then it was Brexit. The corporate tax issue in Ireland. Like it is endless the amount of topical problems that come every quarter. This one is a particularly bad one. But as I said, what drives markets ultimately, they're long-term assets. They're companies that have got exposures to long-term, particularly what we like, long-term structural trends that just continue growing over time. And our job, we feel, as fund managers, is to try and manage the risks around these things short-term, but more importantly, is focus on just that's what drives long-term performance and investment. Really funny analogy I like is someone said, why does the stock market go up all the time? And they said, look, as long as people will pay $3 to Starbucks for 30 cents worth of coffee, the market's going to go higher. And it is that at every industry. Like it's trying to find that it's not all about just the short-term news flow. It drives all our sentiment. It's those longer-term investing and returns on capital.
And I think it's also worth pointing out in terms of we had the great financial crisis, and all of us here had to deal with that at the time. Back in 2008, the consumer is in a much better position now, even today, even facing into potentially higher energy costs and inflation.
It's amazing. I just got off a presentation there at the luxury company, and they had this survey. And basically, when they surveyed what people are positive about, they're positive about their own job, their own health, their own savings. What they're negative about is the economy, the cost of living crisis, and I can't remember what the last, climate change. So it's all these top-down concerns we're reading about all the time, and consumer sentiment is on the floor, like at an aggregate level, and investor sentiment at an aggregate level is on the floor. But people, a Bank of America CFO yesterday was saying their spending in August is up 10% year over year versus last August, and savings haven't gone down. And these are record savings, because employment is 3.5% in the US, it's 3% here. Wage inflation is 7-8% globally. The GFC is a good analogy, because going into that crisis, corporates, households, everyone was over-levered, whereas we actually spent the last 15 years deleveraging. Then COVID came and savings went through the roof, and governments again gave everyone, like the US government this time last year was still giving people $3,000 a family. You know, that was the level of fiscal support. Like, we all know the stories of students here getting the, whatever it was, the €300 a week, even though they, you know, that's still in the system. So it's incredible, the spending stats. I get a Visa and MasterCard out this week. It's spending on travel. It's what's driving inflation, which is another issue, but the health of the consumer still has been phenomenal. And just we feel continued will be, as long as the jobs market is so strong.
And I think I'm going to open it up a little bit, but I'll get the ball rolling. So in terms of maybe if we could kind of narrow it down a little bit in terms of maybe the sectors you like at the moment, or the regions you like, that would be good to hear.
Yeah, so at a regional level, we always think the US long-term will never be beaten, just because of the structure of the economy and what makes up the stock market. So that, and then Europe at the moment, we feel there's a particular opportunity, because the discount that it's trading at versus the rest of the world and its history needs to narrow. We think it's all gas, because the euro versus the dollar as well is trading at a big discount compared to what the interest rate differentials in the two economies will be. So there's a big sort of gas, Russian-Ukrainian discount in European assets that we feel will narrow. So we're overweight European and US assets. Within that, slightly different in what we own. Europe, we think, a huge opportunity within industrials that are exposed to decarbonisation, for want of a better word. It's always been a huge topic. It's accelerated because of the crisis in the Ukraine, and so many European companies like Kingspan, Saint-Gobain, Vestas, Ørsted, they're all at the heart. Like, Europe's actually led the renewable charge over the last 5 years on decarbonisation, which is amazing. So Europe hasn't really led anything for a while, but now the US has picked up the slack. So we saw, if you saw last week, Joe Biden's big fiscal package. He called it the Inflation Reduction Act for some reason, but it's purely to kickstart the US investment in decarbonisation, and it's transformational. And that's not me saying it, it's the Next Era CEO, which is the biggest renewable company in the world. He said it's the biggest transformation of their industry ever. Overnight, they've made green hydrogen, for example, competitive with fossil fuels. They're giving $7,500 credit if you buy an EV. They're just the whole supply chain. It's $350 billion of investment credits. It's $250 billion of tax credits. It's over 10 years, but it's actually targeted until they reach the emissions targets of the Paris Accord of -2%, i.e. it's never going away. You know, we're not going to reach those in 10 years, so it'll be a 20-year thing. So, so that's Kickstarter. But yeah, European decarbonisation, and then European banks, all of a sudden, so for 10 years, underperformed, regulation, low interest rates, et cetera, et cetera. I mean, their interest rates started to rise, and the banks didn't really react to them as much as they thought. In the last 2 weeks, they have. We feel that's only the start. And the reason in the last 2 weeks they've reacted is because the ECB are allowing banks to keep all the extra money they get from interest rate rises. European banks made 68 billion in revenue last year, which isn't a lot, like it's less than Microsoft. if you follow where rates are priced for the end of the year, that 68 billion will go to 168 billion. Now, they'll pass some of it back, but it's transformational for an industry that is trading, 4 or 5 times earning, half times book, and it's effectively, this is like risk-free income, like it's literally the ECB giving it to them. So this is a huge transformation for like a quite a cheap sector. In the US, we particularly are always involved in the growth names and the US tech names. This year, it's been particularly difficult for them, not just because interest rates went up, that was one of it, but some of them did make a lot of mistakes post-COVID. So now it's just trying to sort of weed through where the opportunities are, and we can see huge opportunities, mainly from what management are changing in the likes of Netflix, PayPal, in particular are two of the largest ones for us, as Amazon and Google. And the reason is all those names are heavily exposed to e-commerce trends and digital advertising. And essentially what happened was these were, say, things that were growing 10% pre the pandemic. For 2 years post-pandemic, they grew 20% and 20%. And then going into this year, people were still modeling that they'd grow that high. In actual fact, they grew slightly below average. And the market then repriced that this whole industry was X growth. And then it's actually not, a lot of it was the dollar. And then in the last 2 or 3 months, you're actually seeing these trends are normalizing again, whereas the stocks are trading at big discounts to their long run averages. And also management were a bit chastened. So finally, you're seeing these are very successful companies with a lot of people who are paid a lot, free lunches, and the management are taking a load of cost out as well, finally, which is always good to see, a bit more discipline. So that in the US for us, but I'd actually say, when we go through, another reason why we're constructive on just markets generally is that when we go through each industry, whether we own it or not, we can see very sensible reasons why you should own it or could own them. Again, mistakes pre the financial crisis, generally around over leverage, are gone. I can't find a sector that's leveraged. Like house builders in the US now, obviously, which is at the center of the problems in the US with rates going up. Even stocks like that, probably yielding 7, 8, 9%. A house builder, if this was 2008, these companies would be giving you rights issues and, like they'd be on their knees and everything, but it's not. So that we find is probably most encouraging. So if you look at the world bottom up, we're also just for markets, we talked about inflation, cost of living, labour, wages. It's record margins. Corporates have record margins at the moment. They'll have record margins next quarter. We feel it's one of our big themes and trends. It's just digitalization, it's the investment in technology, the ability to do more with less. It's been going on for the last 10 years. It's going to go on for the next 20 years. And you see it in every industry, every quarter. FedEx announced a huge investment in their own cloud investments that they think they can take out $1 billion of costs just by moving to an external cloud. Who runs the cloud? It's going to be Microsoft or Amazon or Google. And it's just this self-perpetuating cycle that people pay attention to when the markets are booming, but everyone forgets about it now, but it's still what's going on. So we think allowing for the volatility, allowing for all the issues that, given how poor the markets were really into the start of the year after it, that the opportunity for us is just to stay invested, try and work out the opportunities.
So is there anybody out there who has a question? Yes.
Do you see the dollar rate continuing to be strong versus the euro?
So, sorry. Do you see the dollar rate continuing being strong?
No, we think it's reached peak parity. And the reason is because the Federal Reserve led the interest rate rises globally. The ECB is now catching up very quickly. So when you look at the two currencies on just that difference in interest rates, the euro should actually be about 110. But we think there's just a big discount at the moment because of the Ukraine-Russia war and the subsequent gas crisis. And when that normalizes, you should see, we think you'll see quite a huge catch-up in the rates. Now, it's slightly counter-consensual. The strong dollar is quite baked into a lot of people's expectations, but we see a situation where the ECB will probably be still raising rates early next year, and the Fed will actually be looking, probably maybe even be forced to cut them. So feel on a risk reward, it's peaked.
Anyone else?
Just a question. You mentioned there about the tech markets in the US in particular. Are you seeing any trends or investment opportunities as a result of working from home? I see Europe is kind of coming back into getting back to the office. The US are not. And some companies are even staying long term now, work from home. Do you see that impacting the markets or any opportunities and or trends? Yeah,
it's huge. So you're right. So the stat we got at the end of August was 44% of US offices are empty. It's like we're 2 years from the crisis in the US because they reopened earlier than us. So they are very much entrenched in working from home. So yeah, what it's done is it's increased. A lot of people thought some of the tech spend would have to normalise because as we all come back to the office, but actually it's the opposite. You now need a dual structure. You need to be able to have investment for your staff coming into the office or from home. So where it's really playing through is in some of the semiconductors involved in like data centres, so like Marvell, and then Microsoft is always the huge winner from anything software related. You can see how they're bundling up. You know, the Teams system is something probably no one used 2 years ago, and now it's become as essential as email from it. The other impact it's having is the real estate market. It's having a huge impact. So the so-called, what do they call them in the US? The smile states. So basically the sunny states. Prices are going through the roof, rents and house prices, because everyone wants to live there and further out. So it's also impacting that. Trying to think, so mainly the software, anything to do with the cloud. I think that's the tech spending. Yeah.
Alan?
Hi, your view on the UK?
Yeah, the UK is, as I said, we are optimistic on the world and we're constructive on the world. If there's a financial crisis on the back of energy prices, we think it'll be in the UK. So, and that's not like a kind of an Irish sort of thing. Like we don't do a lot in trade in the UK. So you got to remember, like, so the UK grew below par for 10 years after the financial crisis. The George Osborne, David Cameron austerity measures meant it was just growing far below its capacity. Then they decided to have Brexit, which accelerated that trend. But the problem with Brexit was governments had to borrow a lot more. We all had to take a lot more on our shoulders. Britain historically can only funded itself from inward investment. So at a time really after 10 years of growing lower than they should have, they then turned their back on inward investment. And then that was fine post-Brexit because, and during COVID, because the Bank of England and central banks everywhere were stepping in and they were buying everyone's debt. So we could all probably be a bit more extravagant. That's all ended now. And all of a sudden, Britain's got a bigger, this is before Liz Truss's announcements, by the way, Britain's got a bigger debt pile to service. And also, the quirk of when central banks bought their government's debt, they then got the coupons from the debt, you know, the interest rate as you would invest, and gave it back to the Treasury. And it was a lovely kind of rinky-dink going on. The difference in Britain is that Britain, for whatever reason, I don't know, the British Central Bank of England didn't buy the inflation-linked debt, right? So now as inflation's gone through the roof, although they bought 50% of the debt, the expensive bit they left, and those interest repayments are going up. So Britain's left now with its main buyer of bonds gone. Its interest bill is going up quicker than anyone else's. It has Brexit, so it has no flexibility on its economy and its supply chain, so its inflation pressures are worse. Its inflation pressures are then worse even again because Britain, hard to believe it, like is even more reliant on gas than Europe. So that's why you see Britain's inflation figures are like double digit already. And Britain decided not to actually help anyone the way we did at source and the way France did. So they were following the IMF's way of like, you just let everyone, take the hit and then, you know, you get them tax cuts 6 months later or whatever. So it means your inflation is even higher. And then Liz Truss has come along at the worst possible time and proposed uncosted fiscal measures of, if you add them all up, it's about 300 billion. Like, it's absurd. She's given an open-ended guarantee on the price of gas and stuff. She has taken back tax raises. She's promised tax cuts, and she's then also threatened the Bank of England's independence. So as an international investor, you're thinking, hang on a second, you've grown subpar for 10 years. The two people you need to fund yourself are either your own central bank or international investors. And you're trying to say, you're promising in Parliament, like this is what happened in Turkey and places like this, you've got £300 billion of fiscal spending you're going to give, but you haven't said where you're going to get the money from. You know, you can compare that to like our government here, like we're giving a big giveaway next week, £8 billion. That's basically nearly all funded by corporate tax. The economy's booming. You know, it won't fully be now because it's increasing, but like that's, you know, it's costed, it's sensible. They've lowered the bar every year in Britain in terms of politics, and it's gotten away. The markets let them get away with it each time. But if there's a tipping point, and there mightn't be, gas prices might collapse. You know, she might rein in what she's proposed, but you can see it. And the reason why I think it's happening is rates are going up in the UK and sterling's falling, and that's a big red flag. Because how do you break that cycle? It's supposed to be the opposite. When the Bank of England are raising rates, and sterling is still collapsing. And what that's telling you is that no matter how much you're raising rates, investors are taking their money out. They don't want the 2 or 3% from gilts that they can get. They'd rather go somewhere else. And that's a big red flag. And we're watching it. And look, I said it might just fade away because the global economy gets on. But if things got worse globally, I think you'd see Britain having a real moment of measure. And the other issue then, is, well, you say central banks step in. But if central banks step in, sterling would collapse. If you see what's happened in the yen in the last sort of 3 or 4 months, it's fallen about 20% because their central bank stepped in to buy bonds when inflation is rampant. Well, not sorry, rampant globally, but they're trying to hold their own inflation down. If the Bank of England were forced to do that, sterling would collapse. It really would. So we're watching this. We're kind of short sterling a bit and short gills. Sometimes these things sort of just pass and no one notices, but it's a problem.
Any other questions? Oh, yeah.
Can I ask you about inflation at the moment? You've been speaking about it. You've been speaking about the power of the gas and everything up to 10%
Yep.
and more in many European countries. And this inflation is really forced on us all because of the war in Ukraine, or energy because of the war in Ukraine. And still the European Central Bank will come in behind it and put up interest rates at this particular time. Is it not really a bit sort of stupid to come along and put up rates at this particular time when people are talking now, like the Central Bank in Ireland was talking about inflation was going to fall in the middle of last year. And like I talked about it on different occasions and said nobody believes that only themselves. And like, you know, really we're in a situation at the moment where we're looking at these increases and increases and increases, but now we're looking at the actual rate increases as well. And at a time when people are paying so much forced upon them, it's not we're all going out spending buying new cars and buying new washing machines and buying new everything. That's not what's happening here. So now the central bank, do you think it's a bit sort of early for them to put up the rates? Or there's actually, I see talk maybe in the past couple of days that those rates may well come back down again. But it's not a bit sort of stupid they're doing something like that?
So just to paraphrase, with inflation being the level it is in Europe, is there not a contradiction with the central bank putting up interest rates?
Yeah, 100% there is. The central banks globally were under fierce pressure because they got inflation wrong last year. So they're now globally trying to oversolve. And the central banks run off a much more academic theory that inflation, you know, the Milton Friedman is always and everywhere monetary phenomenon, which it's clearly not, but they work under that. So having seen inflation go up with negative rates and the Federal Reserve raising rates, everyone across the world raising rates, the ECB sort of groupthink. They were all even in a conference in August together, global central bankers, you know, banging the table, we must do something, and they've raised rates, yeah, to try and crimp demand. It's even more idiotic, as I said, we're just getting the biggest fiscal spending packages off governments to keep demand high, and central banks are raising interest rates to try and temper demand. So they shouldn't be doing it. They should have raised rates last year in advance of what you could see was the strong economy coming through, but they wait for the lagging data on inflation, and then by the time that data came through, the war in Ukraine had started, and they were just forced to do something, particularly the Germans with seeing their inflation 7-8%. The only good thing about the ECB is that it's off such a low level So it was minus 50. It's now 75 basis points. The market at the moment is pricing in about 2% by the end of the year, which I think they will get to there. And then hopefully they'll be able to assess, because, you know, this time next year, if we're sort of even half right on gas prices and power prices and the war in Ukraine, inflation will look a lot lower. Like the actual headline inflation year on year will be really low. And then they might decide to cut depending on the economy is. But I think going back to COVID as well, like so much still COVID, central banks over panicked during COVID in that March, April. At that stage, when the world was locked down, they're forecasting GDP to fall 20%. They all cut rates to zero in a week. And then government stepped in. It didn't take as long for the vaccine. And they just never caught up. They were terrified. Last Christmas, Powell was talking about Omicron. Like, who can even remember that we were worried about COVID last Christmas? That's why he didn't want to put up rates. So they were too slow, and now they're over-solving. It's like the golfer who hooks left and keeps, and aims right and ends up slicing it. They do that. But it shouldn't, I don't think it'll impact. At these levels, it's still manageable for economies. Even Ireland, like the Irish housing market, people are worried about. Interest rates here, by the time they get to the end of the year, you're talking probably, you still get a fixed rate mortgage, 3.25%. It costs you about 4.5% to rent a house. Like, they're still historically low levels of borrowing. Now, the bigger issue or problem will be if we're sitting here in February, March, April next year, and inflation hasn't come down at all. And do they go from 2 to 4%? So, that will be the dilemma next year to try and work out.
And one last question. Oh, yeah.
Hypothetically, if interest rates in the US and in Europe went up a further 200 to 300 basis points, which would be a lot.
Yeah.
If that were to happen, what would your advice on equities be? And would you, if in equities, in which type of equities?
Yeah, well, I suppose it would depend on what's driven them up. If it's the inflation still here next year, all equities will have a problem. The rating, it would be hard. It would mean a very strong economy and earnings upgrade, but it would be hard for the overall market to push on. I'm not saying that it would collapse, but at a simple, decision at a personal level, if you can guarantee getting 6% on savings for 1 year, the balance of how you're going to invest is going to change no matter what age you are. So at the moment, like people have been, it's really been, cash or equities, and that's been dependent on your personal circumstances. That'll change to cash, equities, and bonds. So there'll be there would absolutely be a shift in behavior. But within that, if you got to 6%, certain sectors, banks, you're assuming then would, they treble. I wouldn't mean to say that lightly. The profitability would be so great. You'd also then imply that energy prices have held up here. So it means all the oil stocks, mining stocks, and commodity stocks as well, they're already on huge free cash flows here that people don't really believe. You're implying they'd be higher as well. So that would push on as well. The other analogy, though, I give about people on interest rates, anyone who remembers the tech bubble in 2000, from 95 to 2000, the US 2-year was 5%, and markets traded on 50 times earnings. So the market evolves. Like once rates stop going up, or even just find a level, the markets will push on. Like you can see it in them. Like they're trying. The Fed keep just pushing not when they'll stop hiking rates. The market has consistently sort of said in December this year the Fed will stop. Well, December, January, they'll stop hiking. It's just been the terminal rate has gone up all the time. People say at the start of the summer it was going to be 3.5. Now it's like 4.25, and it's just kind of it hasn't quite got to the terminal level. But when they stop has been pretty consistent. So once that happens, then people will know exactly the opportunity cost and get 4% in the US for a 2-year, or I can buy equities on 15 times earnings with 10% earnings growth and 2% dividends, and be that choice. So that's historically, is that what the volatility has always been caused at the start of the rate hiking cycle as the markets try to work out when it ends. And it usually takes the market historically 3 months to work out when it ends. It's 9 months now at this stage. And that terminal rate just keeps eluding the market.
Okay, thank you so much, everybody. I want to thank you all for coming along today. It's been really wonderful listening to Phil. I barely had to ask any questions. As you can see, an absolute vast wealth of knowledge there. We are going to be sticking around afterwards, so we'd love you to join us for a glass of wine. And you can quiz Phil one-on-one as well. So wonderful. Thank you very much.
Thank you.